investors can use, banks can rely on. So if we speed up this process, I'm seeing some shortcuts being taken, and it will be to the detriment of the quality of the numbers you can rely to see whether a business is making is stating the correct numbers or not. In terms of working days, I'm also privy of probably judiciary working, but not KRA. So if I can stick my argument on KRA, for instance, they will not work late on Friday, for instance. Somebody has said Friday afternoon. I was worried to say it, but let me say Friday afternoon. So you can imagine the challenge we have of working with them for 4.5 days, whereas me, I have to struggle and work throughout, because I'm the one who has received that huge demand, of which most of it is not correct, because of them lacking the understanding of my business. Then it is the struggle of burden of proof lies with me as a taxpayer and not Kenya Revenue Authority. In terms of Section 24, Mheshimiwa, Section 24, the 60%, I would say remove the 60%. Let it be as it is. And let it be between KRA and the taxpayer to agree on probably what proportion needs to be declared on that. Amnesty, the reason why we are saying extend it to June 2027 is because, again, of cash flow issues. It's not that businesses have money currently just to pay taxes which fall. Some of them really struggle because they have to collect this from debtors. And true, whether we leave it on 31st of December 2026 or 30th of June 2027, we will still see last minute filers of amnesty on this particular situation. Thank you, Chair.
You seem to have been asked by something, Raboni.
The reason is giving of 4 months and rushing to go through the audit. Now, when we were submitting, I was wondering, do we have shortfall of accountants in the country? Why can we expand? Because to me, I'm seeing an opportunity for the audit firms employing more people to do the work. So yeah, I'm already seeing an opportunity where we can create jobs, formal jobs in the accounting sector. Yes. I think we need to think outside the box. Automation, more employment. Yeah. Yes. Yeah.
Mheshimiwa, there is danger in everything. And I'll give you an example.
No, even now we are in danger.
Yeah.
But
there are 900.
the assumption is...
Order, Bomboni, finish your question first, then I'll give you a chance to respond.
Yes.
Let's avoid the exchanges.
Actually, there is a danger of everything. But, you know, we are also looking at efficiency. In fact, when my sister was recently saying we don't work on Saturdays and Sundays, I was wondering, on Saturdays we are here up to around 6, and we're also talking about 24/7 economy. So look at it in terms of creating more employment, automation, and all those things. It may not work now, right? It may not work now, but, you know, in future, this is the direction we are moving. I will give you an example. In government, we passed a law just last year, and the government departments, yes, they are supposed to submit their accounts to Auditor General 3 months after, to 2 months. That is government. And, you know, private sector, you always say government is inefficient. Now, we expect you to be more efficient, more than a government, right?
Actually, without deliberating on that, as a practitioner, I think probably supporting Mushumu, I was actually marking on this. Well, as also auditors, because I belong to that, we must also align our work with where the world is, with where the business world is, because every business is desired as to automate the work for efficiency and effectiveness. I understand when you talk of quality of review, but then that means as we digitize and get more young people to work, we reduce the work for senior officers as we certify our reviews on compliance, financials, so that it will become a continuous way of doing work. Because even 6 months is not enough. It is still not enough. And you are blessed if you have many clients, then open opportunity for many people. Some people have got less clients, but big work in terms of complex. So it's not the same in environment. But still, this is a call for us to be effective and efficient in terms of reporting on time so that we move forward. Because even 6 months, 12 months may not be enough. Thank you.
CPA.
So please respond to that.
Yeah, just 1 minute. CPA, I'm happy that you agree with us. 6 months might not even be enough. And that's why we are saying, please let's keep it at 6. But what then we can think is have a transitional period going forward. Because, for instance, right now, if KRA puts its foot down on the requirement, or rather the system they are asking us to file returns, for the first time in several years, we will have more number of tax filing defaulters than ever before. Because as a firm, we've only filed like 10 returns. We are on 25th of May because the system is not allowing us to file. So it's easier to say we agree on 4 months, but the practicality of the process of filing these returns, it will be a challenge in 2027.
I think perhaps if there was an assurance that the systems will always work and there will not be a system upgrade and a system failure for a whole week, then that would be the ideal situation. And I think here, what I remember, so of course now we'll be making a decision is to have a balance. So if you are requiring that time duration of the taxpayer, the same should be expected of the authority. So that it is not that you are pushing me to make sure I do it within a limited amount of time, but then you take your sweet time to respond or whatever action you're supposed to do on your end. Thank you very much. We thank you for your contributions. For the last 9 years I've served in this committee, you have always come to make your presentation, and this committee has thoroughly enjoyed and benefited from the contributions you make. Thank you very much, and continue building the nation.
Thank you, and have a good day.
Asante. And as we leave, please also help us. We seem to be back where we were in 2025 on misinformation and disinformation. I'm seeing people saying we should reject this finance bill because it has tax on land. And I'm like, what? It has tax on mitumba. It has tax on so many things. And like even your explanation, even the proposed excise duty on phones is will actually mean a reduction in terms of the tax rate that is there on phones. But I think the question is that point of activation. How do you determine what point of activation, and how do you determine the value of the phone at activation? I think if those two are handled, then it's actually a better proposal than the current law. So thank you very much. I had indicated that we'll give Kenya Private Sector Alliance next opportunity, but because we have a whole hour, so I beg your indulgence. We have Capital Markets Authority. They've only asked for 15 minutes. They have just 2 submissions to make so that we can give you sufficient time. CMA. Wana nini alafu wanapotea? CPF, CMA. Okay, if they're not ready, let's do Kenya Private Sector Alliance. So CMA, I've only agreed to indulge you because you've said you only need 15 minutes, so make sure you stick to your 15. Because the next presenter has cross-cutting issues across all sectors.
Thank you very much, Chair, for your indulgence. We are waiting for the President of Association of Pension Trustees, Mr. Jose Akili, who went to the bathroom. Just give him a minute, kindly.
But you can proceed. You'll find us on the way.
Okay. Thank you very much, Chair and honorable members of the committee. By way of introduction, my name is Willie Njoroge. I'm the CEO of the Kenya Association of Stockbrokers and Investment Banks. I appreciate the opportunity.
Have you uploaded your document on our system?
Yes, Chair, good morning. My name is David Wainaina, Head of Trading at the Nairobi Securities Exchange. I thank you.
Honourable members, their document is appearing as CASIB. Yes. We are looking for CMA. So CASIB is the document is KASIB. Proceed.
Good morning, Chair. Janet Waiguru, Chair, Custodian Association. Thank you.
All right, Chair, our document has got 7 points. We have attached our introductory letter. Our first point is with regard to stamp duty. And what is our request? Our request is stamp duty to be levied as a percentage rather than an absolute figure. So we have put there what the current legislation is. And you see, for example, a taxpayer will pay 2 shillings for every 10,000 worth of shares traded. Our request, Chair, is for this to be a percentage. Why do we say so? We have calculated it at exactly the same rate it is, 2 shillings for 10,000, but we're putting it as a percentage. This is because the smaller retail investors in the market are disadvantaged. Because if, for instance, if I can illustrate, if you are to purchase, say, shares worth 5,000 shillings, and currently through ZD, which has become a very popular avenue for Kenyans to buy their shares, ZD's average trade size is 2,800 shillings. So if you are to buy shares worth 2,800 shillings, you'll pay the 2 shillings. And if somebody else was to pay or was to buy shares worth 10 million shillings, they'll still pay 2 shillings for every 10,000. So the smaller retail investors are disadvantaged, and we feel that in the interest of equity or being equitable, that it should be levied as a percentage. Before I proceed, let me allow Mr. Kelly to introduce himself.
Chairman and members, my name is Dr. Kili. I work with the pension industry and our association called APTRAC, which is Association of Pension Trustees and Administrators of Kenya. And we're happy to be here. Thank you.
So with regard to stamp duty, Wenena, do you have anything to add? Okay, point number 2. So Chair, do I proceed unless stopped? Thank you. Point number 2 is we are requesting, or rather it is about preferential corporate income tax regime for newly listed companies. What is our request? Our request is so as to encourage more companies to list on the Nairobi Securities Exchange. We are proposing a reduction of corporate tax from 30% to 15%. This request, Chair, is not a new request. The preferential tax for newly listed companies actually existed. It was there. So we are not introducing something that is totally from the clear blue sky. However, at the point when it was in existence, it may not have attracted as many companies to list as we would have wanted, because the climate, the investment climate in the country then was different. It is different today, Chair and members, and we believe that the time is right for us to encourage companies that come and list to have a preferential tax regime. It is also a way, Chair, of democratizing wealth to other Kenyans. We are sitting perhaps in a very good hotel that perhaps makes very good money. Why can't this entity be allowed to come and list at the exchange? And what can we do to encourage such an entity to come and list? Let us give them preferential tax treatment. I do believe here in your audience, we have members from other associations, be they manufacturers or private sector players. To attract them to come and list on the exchange, our suggestion or our request, Chair, is for them to have a preferential tax regime. So we have given our arguments there. I think in the interest of time, I may not be able to go through them, but we have given the monetary benefits and the non-monetary benefits that such a move would come along with. Wanena, anything else for that one? Okay, so number 3 is about our request for, it's about a PIN. I'll ask Janet to take this one over.
Thank you, Chair. Our request is for the expansion of what has been provided in the Finance Bill 2026, where when you look at the non-resident investors, so the foreign investors, they are required to have, to obtain a PIN when they come to invest. So our request is for the expansion of Section 40, Clause 5B, where the provision had been given that a non-resident person shall be exempt from the requirement of a PIN when opening an account with an investment bank. We feel this will be restrictive due to the fact that when you look at the foreign investors, they will open the investing accounts through the investment banks and also commercial banks. So our request is that the provision is expanded to include for that exemption when they open an account with an investment bank or a financial institution. Through the Chair, this request stems from the fact that when we require the non-resident investors or persons looking to invest in this in our capital markets, this is very administrative. And when you look at that non-resident investor, when they invest, when they are receiving their income, either in form of dividends or income, the applicable withholding tax at 15% is withheld at source. So when you look at the listed companies, when they're paying those dividends, they withhold the 15% and remit to the government. So we're not proposing an inclusion in which they will evade tax. It's really removing the administration burden of that, but now including that, it's when they are opening an account through an investment bank or a financial institution. Thank you.
Thank you. Just to emphasize that, Chair, is that this exemption was granted to us by the Finance Bill 2026, your document, Chair, and we appreciate. Only that it didn't quite capture the entire constituency of the people that would use it as we would have wanted it to capture. Thank you. The 4th is to amend the first schedule of Income Tax Act. I'll take it to President Kili.
Thank you, Chair. We have an exemption normally for pension funds, and we want to thank the Parliament for granting exemptions to pension and gratuity. It actually encourages us, or many people now, to save money for investment. Now, after that exemption to the pension funds on tax, we have a small remaining portion whereby if the member who is enjoying pension dies in receiving pension, the beneficiary will be taxed. So the beneficiaries are not given the same exemption, yet these are now children, widows and such people who don't have any other support system. So we are proposing, Chair, that you consider extending the exemption to trust funds established by pension funds, and also for death benefits, so that a member who was exempted before, on death, the benefits should also be exempted. Thank you very much. And I think the rationale covers everybody. It is a very important issue for the entire generations and also for many people. Thank you.
Dr. Kili. Our fifth point, I can see the clock is ticking, is on infrastructure bonds. I will request Mr. Wanyana from the exchange.
Sorry to interrupt. The matter that Dr. you just raised, doesn't clause 20 of the bill already take care of that? Where clause 20, just in case you haven't read, but one of the first schedule to the income tax is amended in paragraph 3 by inserting the following paragraph immediately after paragraph C, benefits arising due to death. So now benefits arising due to death will not be subject to income tax. So doesn't this take care of the issue that you've just raised?
No, yeah. That partly, and we want to thank the committee for that. What I'm talking about is pension funds normally establish a trust fund for the beneficiaries. Now that's where there's no exemption. So you establish a trust fund to take care of the interests of the children of the deceased member who was enjoying already the tax exemption. The trust fund you establish is not exempt. So yeah. Maybe I will also talk about number 5, because we are affected as the pension industry, also on behalf of the NSC, where I used to be a director. Chairman, we want to say that our country at the moment is crying for infrastructure investment by the private sector, and particularly our pension funds and such like institutions. Infrastructure investment by the private sector, and particularly our pension funds and such like institutions with a lot of resources. Unfortunately, the definition by law is that infrastructure benefits like exemption of VAT is only granted to government organized infrastructure bonds. This is not extended to the privately organized bonds. Chairman, I think here is where you need to open up. If the government really, in the same spirit and policy I've seen, you want to get the private sector to participate in infrastructure investment, then we need the same treatment as the bond raised by sovereign. So this is a very important one, to crowd private sector funding into public sector infrastructure investments. So this is something I think we wanted to push, and it's another way of also encouraging long-term investment, because other resources which are normally utilized is short-term, and we don't have such opportunities. Right now, Chairman, because of the changes in NSSF Act and the pension industry, the amount of money which is now being saved by Kenyans is quite huge, but there's not very many destinations to invest this money. We can only invest maybe treasury bonds, but the government borrowing is actually limited. If you want to expand the market where we can invest, you need to open up private infrastructure bonds to this exemption of VAT and other such related taxes, just like the way government issued infrastructure bonds benefit. And that's why it is normally very popular. When an infrastructure bond is issued with tax exemption, it's very popularly and normally subscribed very fast. Thank you. That is our argument, Chairman. Maybe.
So, Chair, as Mr. Kili has said, our proposal is that to expand Section 2 of the income tax so that the private entities can actually be able to also issue infrastructure bonds as within the expanded definition. Thank you.
Number 6 on our list, Chair, concerns our request that under Retirement Benefits Regulations or Act, we find that in Kenya, we have not introduced structures like Sharia compliant asset class, formally. I know my institution was the first one to do a Sharia compliant Sukuk bond, and it was fully subscribed. But now the market, the Islamic finance market demands these investments. And I want to say that I thought we were going to be the first one in Kenya, in East Africa, to do it. But I've just seen Uganda has just released a Sukuk bond by the government itself. So I think it's worth considering, because at the moment, there's a lot of funds which are looking for Sharia-compliant investments, but we do not have these instruments available in the market. So we would like this committee to consider that. And together with that also, is to also put in an asset class which we call pool funds. And under pool fund arrangements, here we can get another instrument for pooling pension funds into a pooled fund instrument, which is similar to what insurance companies have. We normally call it guaranteed funds. So we want a similar treatment for the side of pension funds to be able to invest in this instrument. And that means we will have many ways of getting money into a pool for purpose of additional investment. And those are the amendments we are proposing. The last one, number 7, is now we would like our regulator, RBA, to have an extension to handle and regulate establishment of trust funds. Many members who pass on while in either before retirement or after retirement, the best way to manage their funds is in the trust fund. But these are not regulated arrangement at the moment. So we'd like to request that this is also made part of the responsibility of RBA so that we can have a regulated environment for trust funds. Thank you very much, Chairman, for giving us audience.
Thank you very much for your contributions. Just for your information, we just have published today the Trust Administration Bill. So I think it just came from the government printer this morning. So you might want to familiarize yourself with that. I think that will be, but I don't know whether it will come to us or to the Committee of Justice and Legal Affairs. Most likely it will go to JLAC. So I think you may want to really prepare for that, and your submissions on the issues of trust could be better handled in that particular bill. Honorable Mboni?
Thank you very much, Chair. And I really like their proposal. And basically, these are actually new proposals to the bill. And when they were presenting, especially on the preferential corporate income tax for new listed companies from 30 to 15%, what was coming to my mind was the Nairobi Stock Exchange. We have not seen new companies listed for 10 years, after last year actually. And I was wondering, what are the reasons? Because this one cannot be the only reason. There must be very many reasons. And I will tell you this. This is a friend of mine who has been wanting to list in the real estate investment trusts. And even to see the CEO for a meeting is a problem. I intervene, and up to now, you have not been able to see the CEO. So, as much as you are proposing this, then you also need to look at how the CMA itself is operating. Because it may be the problem, not the corporate tax. So as much as you bring these proposals, then you also have to need to look at other things so that at least people can be able to list, right? This friend of mine does not want the corporate tax to be reduced from 30 to 15. He just wants to list. But now to see the CEO is a problem. Thank you.
Just speaking on presentation number 3 on PIN exemption, I would wish to get clearly what is the importance of request by the stakeholder here that we extend, we open up more reach on this PIN exemption on non-residents, especially when they are talking of aligning with Tax Procedures Act, extending a framework to regulated financial services intermediaries. Just explain what is the risk as it is, and what is the importance of opening up. Just brief us that. Thank you.
Before Honorable Paul, ask the two members who've just joined us, introduce yourself, Dr. Mwiti and Mheshimiwa Faramondo.
Thank you, Chair. Dr. Shadrack Mwiti, MP South Imenti, Meru County, member of Finance and National Planning Committee. Thank you.
Chair, my name is Chief Faramondo Mangale, MP Lungalunga constituency. I'm a member of this committee. Thank you.
Thank you, Chair. I just want to ask the President a question, though it comes from my constituency, about this issue of the trust fund. You have said that you want an extension of the tax to go to the beneficiaries. I just wanted clarity. How long do the beneficiaries stay in this trust fund? Because many people will end up being there. So I don't know, is it for a period of time, or it is for as long as they are registered, they will be there? Thank you.
Thank you. I think mine is just a comment. The beauty of public participation, your submission that we change the rates on the shares from being a specific rate to what we call a valorem rate is actually going to yield more, to yield more revenue. So it's a very good proposal. Yes, respond to those queries.
Yes, Chair, and thank you very much. To the first question, where the Honourable Member indicated the process he has been going through with the friend, indeed, allow me, Chair, to confirm that the NSE is a marketplace. And we do meet a lot of people at both local and international level. So allow me, respectively, Chair, to submit that probably that's not an event, but a process. But we are very, very happy post this to support the Honourable Member's friend. And I'm sure they will be satisfactorily addressed. But just to make the point around our proposal on the tax incentives, if you look at the way the NSC has performed on the recent past, for the past 2 weeks, for example, we have had a flux of listings. Today, this morning, we were listing KMRC. On Thursday, we should be listing INM bond. So the time is right for companies to come to the market. One of the greatest challenges that was there before is around the valuation, because companies want to come to the market when they know that the valuation is right. And given that the exchange in the recent past has been one of the best performing in Africa, their valuations are super right. So we believe that if we give these tax incentives, there will be many more companies, especially those of SMEs, that want to probably raise capital by way of equities coming to our market. So, Chair, the proposal before you is going to ensure that we have quite a number of companies across the sectors coming to access the market, because the valuation is indeed right. Thank you.
Thank you. Thank you, Chairman. I actually support that. One of the challenges we have, Chairman and members, is that as pension funds particularly, we are short of where to invest in this. We have only 60 listed companies in this market for many years. Some other smaller economies have got many, over 100 and 200 and above. We are lacking, and one of the challenges when we ask private owners of these companies, they say there is no benefit to list. Now, we have looked at our jurisdictions, Jamaica and others. They provide a certain exemption for some years for a newly listed company. As a result, people are encouraged to come into this market. We would like you to consider this. It's not a loss. It's better when they come in, there's more transparency in the running of these companies, and two, there is now the tax authorities are able to have visibility over the workings of these companies, and therefore they'll pay taxes better. So actually is a good incentive to make them come to the market. Now, on the question from a member concerning the extension of trust funds to beneficiaries, the children, the young children, and also the other beneficiaries like the widows. Normally the funds which are put in trust funds last only for as long as the money is available. So when the money runs out, then that's the end of the trust. So it's not a very long time. It could be 10 years, could be 5 years, depending on how much money was actually passed to these trust funds. But it therefore should not be taxed because they have already been taxed before. And therefore, it makes sense to let these people who have suffered loss of their loved ones to actually benefit fully for school fees and other things. And I run such a fund in my institution, Chair, so I know what it is. It takes care of children of deceased members, and I know even you as members, you have people of that kind, you have your own children. You would not want to have the same be taxed for too long, and yet it's not forever. Thank you very much.
The last one, through the chair. So when you look at the way the foreign investors come into the market, they will either open an account with an investment bank, a stockbroker, or a commercial bank. Commercial banks are licensed by the Capital Markets Authority as custodians, so meaning we carry out safekeeping and settlement of the transactions that they undertake. The way the clause was worded, it excludes the commercial banks, so which then means a foreign investor coming in will be treated differently when they're opening an account through an investment bank and differently when they come and open an account through a commercial bank. So our request then is to ensure that there's consistency in the way we are supporting them and noting that when they pay that withholding tax, it's a final tax, no further obligation, and as I mentioned earlier, there is no way we are looking at avoidance or evasion of tax. So it's really just ensuring that the level ground is consistent in the fact that the investment bank and commercial banks support foreign investors investing into our capital markets. Thank you.
Just to emphasize on that, Chair, this was granted to us in the finance bill, and we are very, very grateful to you, sir. Only that it didn't quite capture the scope that we wanted it to capture. So our only request is just for it to capture the specific scope that we're asking for. And it is something that we held several meetings with the National Treasury and the Kenya Revenue Authority. If they're in this room, maybe they can bear me witness. So it is just the scope that we want to capture. My second point is I feel a lot of pain when I hear that we have people who have tried to come to the market to do listings and have been unable to do so. My assurance to this committee through the chair is that we have an open door policy. That to me sounds like an outlaying position. Should there be any requirement to meet anyone in the capital markets industry, we shall definitely facilitate. Finally, about why there are no listings. There have been listings. I think the most popular one is the government listing of the Kenya Pipeline Company, of which we are very grateful to the government for doing so. But from the private sector, say for example in the last 2 months, we have had 3 listings or more. We have Triffic, we have Spearhead Africa, we have Africa Leasing Properties. But unfortunately, these are not household names. And for that reason, they have not been able to attract the scope of investors that we would have wanted. And that is why we are making this request, Honorable Chair, that if we can be able to attract entities that we can call household names, then you shall have more Kenyans participating in the stock market when they see names that they interact with every day, the fast-moving consumer goods, and so on and so forth. Thank you.
Thank you very much for your submissions. We note your the issue of pensions and trusts and all those matters you've raised. We'll try the best we can to accommodate what we can. And thank you for the new idea of how to raise more revenue. Because rarely do we get such ideas. Thank you. You may take your leave. And now to the Kenya Private Sector Alliance. We've been together enough times, you know the drill. Introduce yourself, take us your submissions. You don't have to overemphasize matters that have been canvassed. KBA, I thought we were with you last week.
We are members of the alliance.
Karibuni. Introduce yourself, take us your submissions.
Thank you, Chair, and thank you, honorable members, for giving us this audience. My name is Jas Bedi. I'm the chairman of the Kenya Private Sector Alliance. And before I start, I'll just give this mic around to the team here so they can also introduce themselves.
Good morning, honorable members, Chair, and everyone here. My name is Jill Shah, Vice Chair of the Public Finance Sector Board at KEPSA.
Good morning, members and Chair. My name is Jane Mwangi, Vice Chair of the Education Sector Board and Head of Secretariat at the Kenya Association of International Schools.
Good morning, Chair and honorable members. My name is Kennedy Mutisia, and I'm a member of this board. Thank you.
Good morning, members and Chair. My name is Wambui Mbarire from the Retail Trade Association of Kenya and the Vice Chair of the Trade and Industry Sector at KEPSA.
Good morning, Chair and honorable members. My name is Dr. Weri Mombogo. I am the current president of the Pharmaceutical Society of Kenya, and I'm here to represent the health sector position from KEPSA, as well as from the Pharmaceutical Society side.
Thank you, Chair, and our members, Kenya Association of Manufacturers, are also here, but I think they have a full substantive submission, so I'll let that do that. So, Honorable Chairman, I just wanted to set the macro picture of Kenya and how Kenya is faring right now. I think there is no doubt that we can say and we can commend that the economy at the moment is about 18 trillion shillings. We've had a stable exchange rate for the last 18 months. We've got 6 months.
Sorry, Mr. Chairman. Our secretary is indicating that you're supposed to present together with KAM. Is that correct? So, oh, yours is different. Pharmaceuticals, at least you are together with. I see what you did, Dr. Werimo there. you know, it's like that young man in Kilifi who rushed the president. And the president says, ukipata nafasi, pita nayo. So we'll give KEPSA, then you present immediately. After, then we address those matters together. Then we have now KAM. Sorry for cutting you, proceed.
Thank you, Madam Chair. So what I was saying is that we must commend the government that the macroeconomic conditions at the moment are all fine. We have an economy which is 18 trillion shilling. We have a stable exchange rate for more than 18 months. We have more than 6 months import cover in our treasury. Interest rates are low with the introduction of Kesonia, and the CBK has been doing a good job lowering the CBR. Inflation is less than 5%, and the economy has been growing at 4.6 to 4.7%. And Kenya, as you know now, is the 7th largest economy in Africa. So if you look at those demographics and you look at East Africa, we are 40% of East Africa's GDP, which is quite commendable considering out of 350 million people, we have 55 million people. So we've done really well, and I think this whole premise of our presentation is going to be on how can we protect the gains and how can we move away from the current situation that we are facing. Of course, we know that the debt serviceability to GDP is 68%, which is very, very high. But we understand that brings a lot of challenges, and that brings about this very aggressive revenue collection. And we feel that revenue collection, which is very, very important, we need to actually be expanding the pie as opposed to making sure that less are paying for more. So as a country, Kenya, I think we've done phenomenally well in the ease of doing business. And I'm sure everybody in this room is going to echo that. We need to now move from ease of doing business to costs of doing business. What is hurting the economy today is the cost of doing business, and I'm very sure KAM, our members, are going to strongly talk about the cost of doing business, because that is what is hurting our core. And our core is our competitiveness. And I think in one word, if we can address just one word today, is how can we make Kenya more competitive? How can we ensure that Kenya's competitiveness is not eroded? I think we'll start seeing a very different paradigm. What we need to move away is from taxing for survival to taxing for growth. So this economy needs growth, and we can do it. We've done it in the past. We need to increase the disposable income of Kenyans, and we need to increase the purchasing power which has been on a decline in Kenya. Of course, we have a situation today in this country and in the globe that we're not insulated and we're not isolated from the global geopolitical arena. We've seen what happened with just one closure of one Strait of Hormuz, the impact of fuel prices in Kenya. So these global dynamics also do matter. So we can't isolate ourselves. And so we really need to think at the ecosystem in Kenya, around Kenya, and in East African community, because that seems to be our biggest single challenge. So, sir, the Finance Bill 2026 arrives at a critical juncture for Kenya's fiscal architecture. As a nation, we continue to pursue the bottom-up economic transformation agenda, and the legislative challenge lies in striking an intentional balance between aggressive domestic revenue mobilization and the preservation of private sector competitiveness. And I repeat the word competitiveness. So while the national exchequer expands ordinary revenue collection, which is projected to 3.38 trillion for 2025-2026, the fiscal cycle, several proposed amendments threaten to create a significant deadweight loss. Overly punitive taxation risks stifling local production, contracting formal employment, and triggering capital flight towards regional neighbors. A policy misalignment at this junction could diminish Kenya's standing as a regional manufacturing powerhouse, turning the country into a net importer of goods and services it currently leads. So we're going back to what I was saying. We really need to maintain our competitiveness in this ecosystem that we operate in, and we're not insulated. So we need to start looking at the scenarios of income and expenditure. Data from the latest Kenya National Bureau of Statistics Economic Survey underscores this vulnerability. While Kenya's real GDP growth grew by 4.6% in 2025, structural labor weaknesses persist. High production costs, unaligned fiscal rules have surpassed the formal economy, leaving the formal economy employment at a mere 16.2% of total jobs, which is 3.5 million workers, while the informal sector handles an overwhelming 83.8% of the burden, which is 18.1 million workers. To ensure long-term economic stability and to avoid fiscal leakage, the Finance Bill 2026 must anchor its tax adjustments across the three core strategic pillars. Pillar number one, enhancing global and regional competitiveness. According to the World Bank, implementing pro-competitive structural reforms in key infrastructure and trade sectors Kenya boost an annual growth rate of 1.35 percentage points. Kenya must align its tax regime within the EAC, the East African Common External Tariff bands, which is 0, 10, 25, 35, to insulate local supply chains. This alignment is vital to maintaining our status as East Africa's primary logistics and industrial hub against nations like Ethiopia and Rwanda, which continue to offer highly supportive and predictable fiscal frameworks for foreign direct investments. Pillar 2 is creating and protecting jobs. Reversing structural weaknesses in the labor market requires a tax regime that encourages industrial capital investment rather than penalizing operating cash flows. Fully optimizing private sector productivity can unlock up to 400,000 decent formal sector jobs annually. The Finance Bill must protect our largest wage employment contributors such as manufacturing, which anchors over 366,000 formal sector jobs, and agriculture by removing unclaimable input tax burdens that force staff layoffs, automated downscaling, and complete closures. We have a serious situation in the agriculture sector, especially for the exporters who are really unable to claim their VAT, and it runs into months and months and months, putting severe cash flow constraints into their businesses. Pillar 3, enhancing government revenue legitimately. True revenue mobilization is a byproduct of expanding the economic base, not increasing the tax rates on a shrinking pool of formal taxpayers. High tax rate historically trigger tax evasion, drive businesses in informal shadows, and lower collections. By keeping tax rates predictable, simplifying compliance procedures, and introducing clear valuation safe harbors, the government can stimulate compliance, encourage informal enterprises to formalize and sustainably grow the ordinary tax revenues in line with the Treasury's targets. Further, KEPSA is highly appreciative of the collaborative wins realized in the Finance Bill 2026. These positive inclusions are a result of sustained private sector advocacy through structured engagement, policy dialogue, and evidence-based submissions to the National Treasury and the National Assembly. The following key statutory amendments reflect a mutual commitment to fostering facilitative, growth-oriented business environment. KEPSA notes with appreciation some of the presented proposals of the private sector has made during various engagements with the government agency. The proposals in the bill include, and we are very thankful for that, a win on the tax amnesty extension, where the 100% applies for a principal tax to be paid by December 31, 2025, or if any outstanding principals are fully settled by December 31, 2026. And I think that sorts out the issue that one member raised earlier on. I think we're thankful that that has been accepted. We're also thankful that reduction on the excise duty of the ENA, extra neutral alcohol. The win is, of course, the reduction of duty on unnatured extra neutral alcohol from 500 shillings per litre to 50 shillings. The context is this punitive tax structure on a foundational industrial base was driving us manufacturing costs. The impact, of course, as we know, is going to drastically slash raw material costs for formal manufacturing. So as we move forward, I think it's important that we look at the revenue statistics of this finance bill, which we have. The Finance Bill 2026 fiscal scorecard stands as follows. The potential revenue gain if all contested clauses are enacted is between 35 and 90 billion shillings per annum. The revenue foregone if KEPSA wins all the contested deletions is between 35 and 75 billion. So that's really the financial impact of this Bill 2026, which I think is super important. We're looking at one-time windfall in VAT reversals, amnesty on the principal. It's about 5 and 15 billion. It's a one-off. The pay-as-you-earn rate cut proposed for direct revenue is about 28.1 billion shillings, but the estimated pay-as-you-earn and indirect recovery on VAT uplift GDP multiplier because of consumption will go up 27 billion to 32 billion. And so if you look at the long-term gain proposed in year one, we'll actually be better off by 210 billion shillings on our GDP output, which actually tells you that sometimes these taxes can be counterproductive as opposed to be productive. So we are actually now saying that we have all of our members in the room here, and we have sector-specific situations, which I would like to pass the mic on. But by and large, we're here to stand with you and to make sure that we get this right, and so that we can actually grow our economy, grow the pie, grow the jobs, and make Kenya competitive. Thank you. Thank you. On to Jill.
Thank you. I think most of the proposals, as you've rightfully said, have been done by the previous team from Grant Thornton, so I would not like to repeat, but a detailed submission has been shared with the Secretariat, and we would just like to re-emphasize on some very key ones which we feel would be important at this stage for consideration as KEPSA. And perhaps the first one, and I'm not going to go into the detail on the deemed distribution or the deemed dividend distribution tax, the one that stands at 60%. You'd asked that question to the other team, what would be your proposal when it comes to this? And our proposal at this stage would be at a maximum to keep a ceiling and maybe a maximum of 30%, provided where the company cannot demonstrate that they cannot apply those funds in various company reinvestments or working capital requirements or whichever other requirements which the businesses might have. So, but capping it to a maximum of 30% as opposed to leaving it as open as it is in the also quite detrimental, because now KRA also has a free way of just charging whatever figure they would like. So our proposal is 30% at a cap on the deemed distribution. There is another one that we would like you to please consider, and that would be on the, which is not in the bill, but a carry forward the extension of tax losses. Now that has been a bit of a setback when it comes to getting investments in the country, because 5 years is not enough to get a very heavily capital intensive industry to come and invest in Kenya. And that's where we are losing out. So our proposal is to increase the period to 10 years from the current 5-year period. And also the way the implementation, as you've also rightfully noticed, there has been a bit of a misinterpretation of this clause where there was no transitional provisions that were given to at the time when the law was enacted last year. So KRA's interpretation has been very different. They're saying that any loss from 2020 cannot be used post-2025. And that's the wrong interpretation. And there's even a court ruling to that effect. So perhaps this would be a good opportune time to clarify that matter via the finance bill and enact it through the act and ensure that we do not have these misinterpretations of the law. As you've rightfully said, there's a lot of misinterpretation of the finance bill. But these are the good ways to also correct what is also misinformed even by the Revenue Authority. Another one would be on the issue to do with the tax filing deadline. We are pro doing this, especially on the 1 month for nil returns. That's doable. My challenge is the systems need to be robust. They need to be ready before we pass anything into law. Whenever we talk to the Revenue Authority, we always find the laws are changing so fast, we do not even have time to amend the system. Classic example, even on amnesty, let me tell you, we will be October, November, and there'll still be no return available for us to file that amnesty return. And that's the reality on the ground. When it works to, doing things and the back-end systems. So our plea is, before any laws or anything is considered, please look at the back-end of the system's infrastructure and whether KRA has the capacity to do it. Right now, only 10% of the returns have been filed till date. That clearly shows, and we are in May, so you can imagine the challenge we are facing in just filing the returns. If the systems were so robust, we would have all filed our returns by May, because since they are auto-populated, as you rightfully said, we should not be having these challenges at this point in time, and we're only left with 1 month. And then we are being told that KRA will assist. They cannot assist the millions of taxpayers that we have, because they don't even have the capacity on the ground. So that's where the challenges come from. So I think we're looking at it from a one-sided perspective, and it's good to also look at it from our side as well, where the challenges actually come from on the ground. On another matter, and I'll probably let Kennedy deal with the POIE. Maybe you can deal with that later. The other one is on the card payments and the digital platforms. We are cognizant that, yes, there's the move that everything following, whenever a challenge has always been, whenever KRA loses a case in court, we run towards putting those things through the act and changing the law, because that's the only way to get, themselves to collect that money. But I think it might be a good idea as to why that was never even put in the first place, because there's always some reasoning behind it. And also another thing we have a concern with the finance bill is a lot of these proposals are coming, because they did not make it into the previous bills, is now we're going back with the same proposals again and again and again. And there's a reason they did not succeed the previous time. There's a valid reason why you as a committee also did not push them through. So our request is, please reconsider these again before making any key changes to the law, because we keep saying we are talking about going towards the national tax policy, which changes, which says do not keep changing the law, every 5 years. Here we are changing a law that was just enacted in 2025. So it does not give any investor in this country any comfort. And believe you me, we deal with a lot of foreign investors, and they are finding it very challenging when you keep telling them the law has changed again, the law has changed again. So when it comes to investments, they're really, taking a lot of time to think whether they should or should not. So on the issue with card payments and the digital platforms, the withholding tax, this we definitely oppose the amendment in its entirety. This should be deleted. And it's going to be very difficult to identify who is the payer. The practicality of implementing such a provision is very difficult. We have found that you will not even be able to identify who is the payer in this instance. So before we understand how the flows work, and maybe I'll let Kennedy deal with that in detail. Same thing with the withholding VAT on digital services. We're trying to move everybody to be more transparent. Yet with such proposals, we're increasing the cost of doing business. So what are we saying? Are we moving back to a cash economy where then transactions will no longer be visible? So that's one key challenge with such a proposal. There's the issue of bad debts refund. This was changed last year because we are facing a very tight cash flow challenges. The previous presenter also said that debts are also not being collected on time. As a business, if I'm not able to collect my debt, at least allow me to claim my bad debt in good time and not make me wait for 3 years. And there was a reason we changed it to 2 years last year, and now again we are moving back to 2 years. So, sorry, to 3 years from the 2 years. So instead of allowing cash flow reliefs, we are making it more and more difficult for businesses to be able to get those reliefs. On the issue to do with the mandatory reversal on input VAT, there's a proposal that we need to reverse the input VAT that has already been claimed. The only challenge here is at the time of importation or purchasing, that law was very clear, and that time they were making. But subsequently, if you change the law and it becomes exempt, it's now starting to penalize the taxpayer here. And to go back to check which goods is just administratively burdensome, and it'll be very difficult even for the revenue authority, I can see, on how are they going to prove how this is going to work. And these are going to lead in a lot of legal battles at court. On the issue to do with the 90% rule, this is a new proposal that we had the 90% rule that was deleted, which allowed a taxpayer where if you have 90% or more in standard rated supplies, we could claim the entire input VAT. That was changed in the last Finance Act, and it was deleted. So that meant that whatever supplies you make is the amount you claim. The problem is there are many businesses here that supply to exempt institutions, such as KDF, your Kenya Defense, the police, and the likes. So their percentage obviously goes up. And this makes the cost of doing business, because now that exempt is input VAT is what becomes their cost to supplying to these institutions. So our ask here is to re-look at that provision that was deleted, because it has not really settled well in terms of costs. And in terms of agency notices, and I think this is a big, big one, we have a big challenge when it comes to, it's like you're putting in these pay-to-play provisions where you are, where carrier has the liberty to slap you with a frivolous assessment. And before you can object, you need to think twice, do I even have the money? Because if you look at the amount that is being assessed on taxpayers without doing their due diligence in the first place, or their audits very diligently, a taxpayer is going to be penalized here, because you're telling a taxpayer that they have the right to serve you an agency notice even at appeal stage. You're looking at an SME sector which is thriving, which is what we are looking to thrive, or grow in this economy. And by bringing in such a provision, they do not have the money. They do not have that strength to go and pay for such an amount. Even so, are we killing this industry altogether, or by just putting in such a clause of pay to play? So I think these are the administrative provisions that really need to be looked at in detail before, and a lot of thought needs to go in. And because what is the intention of the revenue authority? Because first is to give me a big assessment, then you're telling me I cannot go and object. That's deterring me to play my constitutional right of going to object. And the other thing we have seen, and we have even won a case at court, is they are even trying to enact ITax as the law. And ITax is not the law. The ITax has been devised to make it to be more, to be working in their favor, but it's not really following the law. And that is why I'm saying, before we make any changes to anything, a lot of thought needs to go in, where people's frustrations are arising from just a simple thing called ITax. So it's one of those things to be reconsidered. And I'm cognizant of the time, and just checking the relief from the other one is the computation of time. And I think that has been emphasized quite well, that we need time to object. We are running a business as a country, and all the time we find them is just working towards just KRA, the multiple audits that go on within the business environment. So it's very challenging for a business to be, working on, sorting their KRA audit or sorting their business out. So I think those are the areas where we need to give a taxpayer time to also object. And then we find that there are times you suddenly find an assessment on your system, but it might not be. It might not even be something that they were warned about, that there was even an ongoing audit. So it's unfair on the taxpayer that they did not even have time to object because they did not find the assessment in time. And those are clear instances we find practically even happening on the ground. The one for overpaid taxes, the offsets on ITax, which is your section 47 of the TPA. again, a classic example of how iTax was changed to just restricted to just installment tax and PAYE. And the reason we were given by the National Treasury at the time was that the other taxes, which is your withholding tax and your VAT, is not really, not VAT, PAYE is not really your tax. You cannot even use it against PAYE. So we were told that because that's not your company's tax, it's actually somebody else's tax. So then why did you appoint me as a company to withhold on behalf of your, stop making me a withholding agent then. Even for employees, you can go and collect your employee taxes at the year end, because if you had given me the cash, then I would have been able to pay my, the same thing. But now on the voucher system, which is what this section 47 is talking about, if you're giving me a voucher on iTax, at least allow me to use that voucher to offset any taxes, not just restricting it to. So that reasoning was not making any logical sense that was given at the time. And then there are various other new inclusions as well that we would like us to consider, which are all there on the document for you to see. And because of the time, I'll just hand it over to Kennedy to talk about the PAYE.
Thank you, Jinla. So, Honorable Chair, I will highlight two issues. And the first issue is a matter that is not in this finance bill, and it's a proposal calling for review of the pay-as-you-earn tax bands. As pointed out by our chair, he did highlight that we need to make our country competitive. As a private sector, we have seen that there's been a cooling of the consumption demand for our products and services. And this is largely driven by the fact that the last 3 years, we've seen the disposable incomes of workers having been eroded. And this was largely driven by additional levies and taxes, as well as the statutory deductions that were introduced. So as a point from the private sector, we do appeal for revision of pay-as-you-earn. And our proposal is that a 5% reduction across all the tax bands be considered as part of enhancing the progression of our tax bands. I think various policies, particularly the national tax policies, has indicated that our tax bands are narrow. And we do advocate that this finance bill does consider the progression, enhancing that progression of our tax band as part of aligning our tax bands to the national tax policy. Similarly, also, our medium tax revenue strategy does advocate for the same, and it is on those grounds that we are calling for this review. In addition to that, I think some studies that have been done, particularly the Kenya National Bureau of Statistics, has indicated that the disposable income of Kenyan workers has been eroded by between 10 to 12%. So clearly, Honorable Chair, there is a strong case for us to basically review these tax bands and to enhance the disposable income for our workers. Chair, as a point of supporting these proposals, we've done studies that demonstrate that for the revenue losses that may be forgone by government, there is a stronger case that these forgone taxes can be recouped by the indirect taxes that will be generated as a result of enhanced consumption, as well as investment and savings. So we do believe that there is a strong case for review of these tax bands. The other element that does support our proposal is the need of what our chair indicated about the competitiveness of our country. And when we benchmark our personal tax structure vis-a-vis the other countries, like for example, South Africa, Ghana, as well as Nigeria, you note that our tax bands are quite narrow. And hence, for us to enhance our competitiveness, then we need then to align to our other jurisdictions that we are competing for resources for. The other item, Chair, I would like to highlight is what Gina spoke about, the concerns from the private sector on the proposal to introduce taxes on financial services, particularly those services that have been introduced or are there to enhance payment channels. One of those concerns is the introduction of VAT, particularly on the technology channels that have been provided by the fintech. As a private sector, we rely heavily on these channels to promote commerce and trade, and the introduction of any taxes to these payment channels will adversely impact our businesses. So it is our appeal that this proposal that is there to introduce VAT as well as introduction of withholding tax on card services be reconsidered because it will have a negative impact in terms of how commerce is undertaken by our members. In addition to that, I think these two proposals of tax in financial services are quite regressive when compared to our national agenda to drive a cash-light society. So as a country, we've made tremendous gains, particularly on the financial inclusion. And this has been enabled by these technology platforms, particularly like the mobile platform, which has enabled our citizens to access financial services. So introducing these taxes will certainly erode those gains that we've been able to gain as a country in terms of our financial inclusion agenda. And of course, also to add on to what Gina indicated, the complexities of also implementing some of these tax proposals might be quite onerous for some of our players. So Chair, we do submit on those two proposals. Thank you.
Thank you very much, members and Honorable Chair. I think mine is re-emphasis on the payee brackets. As I speak for the retail sector, I speak for the consumer. And we have seen that the levels we have post-COVID of consumption are actually lower than they were immediately after COVID. And it has to do with everything that Kennedy has outlined. I think as the chair had said, the issue of continuously having high taxes that will then trigger tax evasion and obviously drive businesses into the informal shadows. I think the honorable member sitting next to you had asked what percentage of the economy is automated. If I speak for the retail sector alone, we are only at 30% automated, and in most cases that 30% then translates to lower than 15% in the back end. And as we move towards trying to formalize, I know clause 50 again talks about e-teams, so there's a need to again look at the levels at which e-teams is being applied, because we do not want to close out MSMEs yeah, from having to trade with a growing formal sector. We do request that we again reconsider the application of e-teams. Thank you.
Is it morning or afternoon? Good afternoon. I will make submissions on behalf of the education sector. As a country, we are emphasizing access to education, the quality of that education and equity. And at the same time, as a private sector, we would like to see Kenya become a hub for education in Kenya. In order for us to continue doing that, we already are, but in order for us to continue doing that, we do have some recommendations for us to be able to attract and retain key faculty and also continue expanding the sector. Just to demonstrate how big of a sector this is, it is sometimes misunderstood that government is the biggest employer of teachers. But in real sense, private sector employs more than 300,000 teachers. So in order to continue to do this, we are proposing that we amend paragraph 4 of section 6(2) of the Income Tax Act and section 5(4) of the Income Tax Act, because we would like to, and this would enable our staff in schools to be able to provide education to get education in the schools and in the universities and the colleges that they work in. Recently, we saw the PS for basic education saying that government is struggling to provide full capitation to schools. As private sector, we would like to be able to provide this to our employees at no cost to themselves. But if it is treated as a taxable benefit, our teachers, our staff are not able to access this, and this places a burden on the exchequer because they take their children to where government is required to provide capitation. So if we amend Section 5(4) of the Income Tax Act and Section 16 of it, then we will be able to provide that. To just back this up, the High Court has pronounced itself on this matter by stating that it should not be the school fees benefit, whether that is a concession or whether it is provided for free, should not be taxed. So we are only asking that this is recognized in the law. And our second ask as a sector would be the Tax Procedures Act. We are required to invoice for school fees on items. I cannot describe the logistical nightmare that is. Consider a school that has 4,000 students. You have to ask for the pins of these parents, and to do all that, we are asking to be exempted as schools, colleges, universities, and this includes public schools that charge the boarding fee. This will not result in any loss of revenue to the government because VAT, school fees are VAT exempt, and therefore the cost on invoicing of school fees on items is not claimable as input tax, input VAT. So there'd be no loss to government, but it would ease the pressure on us extensively. So we would ask for that. And then finally, we would like yourselves to please consider the deletion of paragraph E of the regulation 12.2 on the income tax of the Income Tax Act. That is the charitable organizations and donations exemptions rules for 2024. And it states, let me read it in full, in the case of fee charging educational institutions, full scholarships are granted to at least 10% of its student population who must be from poor and needy backgrounds, and the selection criteria conforms to the requirements spelled under these rules. We understand what your intention was. There are very many people that try to hide under this rule, but we submit, and the courts have agreed with us, that charitable activities extend to far more than, there's a way to demonstrate that you're a charitable organization by not just by giving scholarships. Let me use an example. Tenwek Hospital, I think in Baringo, there is an entire yes, in Bomet. Yes, the staff there need to educate their children. Those children are in a school. They are in a school that charges school fees in order to be able to support the staff who provide that benefit to Tenwek for free. So if we could just be treated as any other charitable organization, allow us to come to you and allow us to go and ask and prove, but to give us this cap on 10% strictly, it is narrowing, and it is not recognizing the fiscal realities of this country. I think the Quakers provide the bulk of education in Western, and they do so much more, as do the Catholics, etc.
I like your spirited conversation, yes, and how you're passionate about that regulations. But allow me to just cut you short, because it will not be possible to amend regulations through this legislative framework. So that would be a completely different process altogether.
No problem. I think I then submit for the Income Tax Act itself, 5.4 and 16.2. Yes, and the procedures. Thank you.
Thank you very much. Chairman, as you're aware, CAPSA is the apex body of the private sector in Kenya. We have with us, we have 80 business member organizations, and in this audience today we have 9. I'd like to recognize all 9 of them, out of which 2 are going to be making submissions to you after me. The Kenya Association of Manufacturers is here, the Shippers Council of East Africa is here, Pharmaceutical Society of Kenya is here, the Kenya Bankers Association is here, the British Chamber of Commerce of Kenya is here, the Kenya Air Operators Association is here, Traction is here, the Kenya Association of Internal Schools is here, and the Kenya Flower Council. So we are fully representative. If there's any question that is required for the other 7 members who are present here are also available for Q&A. But I think you've given audience to 2 of the 9, and we appreciate that a lot. Thank you very much.
Thank you very much, Mr. Chair. Please allow the pharmaceuticals, now that you're presenting jointly, to make their presentation, and then have a round of questions.
So thank you so much, Chair. I do hope that I shall be allocated my 30 minutes. But
we'll get 20.
20, that's fair. The Pharmaceutical Society of Kenya, as we speak today, is the umbrella body of pharmacists in Kenya. And above all, our goal is to ensure that the constitutional right to the highest attainable standard of health is actually, as envisioned in the Constitution, is actually maintained. In addition to that, in line with the country goals, universal health coverage becomes a very huge factor where access, affordability, and quality of medications forms the centerpiece of that enforcement. Within Kenya, we also have a third aspect where Kenya is trying to acquire an ML3 higher regulatory status that demands more stringent aspects when it comes to pharmaceutical care and product perspectives. And the fourth one is the reimbursement structures within Kenya, where we all know that SHA is a huge conversation. And in law, in LMICs, and WHO has confirmed that medicines take up to almost 70% of healthcare budgets in the country. So within that, we know that the beta agenda for the government is to align local manufacturing as a healthcare, security, and sovereignty aspects. So with that, I will just go straight into what our submissions involve. And the first one has to do with Clause 31 of the Finance Bill, where there's an introduction of paragraph 161 of the first schedule of the VAT Act 2013, where there is a proposal to move all inputs and raw materials, whether produced locally or imported, supplied to pharmaceutical manufacturers in Kenya for manufacturing medicaments, from zero-rated to exempt upon recommendation by the Cabinet Secretary. And our proposal is to request that this paragraph is deleted. And the justification is because, number one, it will lead to higher production costs of medicines. The switch from zero-rated to exempt status will also increase the cost of inputs for pharmaceuticals, especially where these are being used by third-party suppliers to the industry, such as producers of packaging material, among others. Again, we'd want also to ensure that it is aligned to the East Africa aspects, where there is zero rating of pharmaceuticals. The second recommendation that we are requesting to the VAT Act of 2013 is in the first schedule to reclassify health products and technologies, essential and pharmaceutical medicines, HPT, medical devices, pharmaceutical inputs, and pharmaceutical manufacturing equipment from VAT exempt to VAT zero rated supplies. While exemption removes VAT on the final supply, it prevents manufacturers, importers, and distributors from claiming input VAT credits incurred during manufacture. This is not in the bill, but we want to sensitize this committee that Kenya only produces 20% of what we call the Kenya Essential Medical Medicines List products. This zero rating will ensure that we are supporting Kenya healthcare goals in terms of reducing cost of medicines and the universal healthcare coverage, promotion of local pharmaceutical manufacturing to ensure that now the inputs are actually now validated. And our calculations have shown that this may result, I know it's in your submission, that this may result into a saving of about 13.4%, and at patient level, it should result into a saving of about 20% of the cost of medicines within the pharmaceutical aspects. Just to give you a snapshot, the government actually pays for medication for their patients. So we actually have a deficit in terms of what we are collecting as well as what we are reimbursing, and 2024 data shows that while SHA collected 57.7 billion, the claims were at about 91.5 billion. And if you consider that this cost is 70 to 80% medicines, then the mathematics in terms of what the government is paying for, this makes this recommendation actually very suitable, especially when it comes to the reimbursement aspects. Also, we all know that the calculations in Kenya is that the pharmaceutical industry is capable of meeting the trade deficits that we are having economically. And now we are looking at ensuring that more investment is brought into the country from a pharmaceutical angle, and we are requesting that the environment is made suitable. Again, to justify this is that international best practice, most countries and many jurisdictions, including Uganda, where we get most of our normal saline and sterile liquids, has a zero rating aspect when it comes to the pharmaceutical products. So in short, all we are saying is that at best, our Kenya Essential Medicines List products should be zero rated at all levels. When it comes to the Income Tax Act, on the second schedule of the Income Tax Act, when it comes to investment allowance, we are looking at the deduction of investment allowance where a person incurs capital expenditure in respect to an item listed in the first column of the table. An investment allowance may be deducted in computing the gains or profits of that person at the corresponding rate specified in the second column for each year of income. Specifically, under Section B, would want machinery used for pharmaceutical manufacturing would be classified as machinery used for manufacture and hence enjoy a capital allowance of 50% in the first year. So our recommendation is to recommend that a new entry, machinery used for pharmaceutical manufacturing with a provision for 100% in the first year of use. And this is just to help in the upfront deduction in the cash flow aspects of the business in terms of manufacturing of pharmaceuticals, because pharmaceuticals cash flow cycles have to take consideration of what you call regulatory aspects of drug registration that have time as well as monetary inbound aspects, and hence this would help streamline that aspect. Also, Clause 30, when it comes to the Excise Duty Act, we are asking for the deletion of the exemption from excise duty of imported printed paper or paperboard from East Africa community. I think this has to do now with the alignment. Well, the bill proposes the deletion of the exemption of excise duty of imported printed paper or paperboard from East Africa community partner states. This introduces an excise duty on the imported printed paper or the paperboard from the East Africa community, and we are recommending that this amendment be deleted. And this basically at face value goes against the preferential customs treatment under the EAC Customs Union Framework Rules of Origin regime, and also creates a tension with the broader regional integration objectives of facilitating free movement of qualifying goods within the EAC aspects. And this may increase production costs as well as reduce the competitiveness of EAC origin goods relative to imports from the region. Again, within the excise duty, we are looking at the application of excise duty on packaging materials, including kraft paper, cartons, and related inputs. For pharmaceuticals, there are four main packaging materials that are considered. That is paper, glass, aluminum, and plastics. And under the Excise Duty Act, locally based pharmaceutical manufacturers are required to pay this excise duty on imported packaging materials, except for the glass bottles. And at the same time, the imported finished pharmaceutical products enter the market without being subject to an equivalent excise duty on packaging component. Basically, our manufacturers end up paying excise duty for the carton and the glass. But when the medicine that comes in as a finished pharmaceutical, we call them FPPs, finished pharmaceutical product, it does not have that aspect. So automatically, the medicines are expensive because they have an excise duty aspect. So this, again, is a contradiction of the industrial policy, where the Kenya's bottom-up economic transformation agenda prioritizes local manufacturing, yet current tax treatment penalizes or seems to penalize domestic production. That as well brings in an aspect of import bias, and also from a supply chain resilience, our products are not competitive. And also now it comes back to our health security aspects, where only 20% of our pharmaceuticals are manufactured locally, and would want to grow that. In terms of the Tax Procedures Act, I know the amnesty aspect has been deliberated by everyone, and I want to say that the Pharmaceutical Society of Kenya agrees. Remember, I am just a doctor, so I might not be able to deliberate on that fully. But when it comes to the e-TIMS implementation, we are requesting that that there's a section 23A of the TPA requires e-TIMS invoices for all transactions, including pharmacy dispensing or pharmacy aspects, which has sensitive patient data such as patient names, prescriptions, and treatment information. What we are proposing is an amendment to that section, subparagraph 4, as follows. The electronic tax invoice referred to in subsection 3 may exclude payments of emoluments, payments for imports, payments of interest transaction, for accounting, for investment allowances, airline passenger ticketing, payments subject to withholding tax, that is final tax, and patient-level pharmaceutical care transactions. As the country moves towards ML3 status, which is a higher regulatory status that allows the country to export our locally manufactured products to more competitive markets, there is an aspect called pharmacovigilance or medical surveillance that demands that even at exit level that we know where the medicine has gone and to who. The fact that now we have to transmit an invoice will ensure that the protection of patient confidentiality is unhinged. The pharmacy transactions may reveal sensitive health conditions, including HIV treatment, oncology, reproductive health services, mental health, and the list is endless. Compliance with the Data Protection Act will be inhibited where health information, which is classified as sensitive personal data requiring enhanced protection frameworks. In terms of medical confidentiality, there will be alignment with medical confidentiality obligations, protection of public health, as well as there are examples where sector-specific exemptions already exist. Other sectors, such as airline ticketing, operate under modified compliance frameworks due to operational realities. The e-TIMS reporting will continue to apply for institutional sales and wholesale pharmaceutical transactions, that is for B2B aspects. And that is my submission to this committee. Thank you so much.
Thank you very much, Dr. You did it like a pro. We wouldn't tell you are a doctor, not an accountant. There are concerns from members from the two presentations, from KEPSA and from Pharmaceutical Association of Kenya. Honorable Mboni, then Honorable Kaluma.
Thank you very much. I have only one concern on the VAT refunds. The proposal to change it from 2 years to 3 years. I think this has been in existence for 2 years, right? If I'm not wrong. 1 year. Maybe probably, have you done a research and see how has been the performance? Have you been able to get your refunds within that 1 year or something like that? Because I know there's a friend of mine who complained to me last year that he has not got his refund of 500 million, which is a lot of money anyway. So how is the performance? Because maybe probably government is not able. They have realized it's not able to do it within the 2 years. That's why they want more time. Maybe what is your views on this?
Thank you, Chair.
Chairman, no doubt the questions. We'll give you a chance to respond to all of them. Honorable Kaluma.
Yeah, Chairman and the team, I'm very grateful for your presentations. But I want you to be our partners in this process and to partner with the government in terms of the running of government. I'm in full agreement with those 3 pillars the chair spoke about, but I'm concerned that we are emphasizing extraction of revenues from government without making, certain and tangible proposals in terms of how the government can seal the revenue gaps that we are creating. Chairman, in terms of your economic overview, the macroeconomy is such that you know where we are. This government is burdened with foreign debts arising from the previous regime. And we are still dealing with interests on those debts. We have not started addressing the principle. We have the personnel and emoluments, including pensions, our obligation annually. We have the county equitable share, which is now going to over 450 billion. And these are constitutional obligations. With all this together, we have development needs to make the economic environment conducive and attractive, as you rightly, advocate. And we are also facing an election year. You know what bodies like IEBC are constitutionally demanding. That makes me want to suggest to you that in as much as you are making these very many proposals, I would personally be very hostile to anything called zero rating. And I want you to address it. Number one, at the level of the pharmaceutical societies and, globally. I don't have empirical data before me that in circumstances where we have moved from exemption to zero rating, there has been corresponding impact in terms of reduction of goods and services prices to the consumers. And so I consider this zero rating as some subsidy for the manufacturers. I was giving the example here the other day that if you go to the bread manufacturing or whatever factories, the bakeries, they now employ more accountants for purposes of, coming up with the tax refunds than the bakers. And we've not had reductions in bread prices anyway. And so I want to be persuaded, because I would be seeking the overhaul of that entire schedule to move all zero ratings to exemptions. I want to hear your views on that. On amnesty, the obligation to pay tax is statutory, and it is about running government. Why should we have amnesty? If we're just allowing you to stay with money, we need to deliver goods and services to the people of Kenya. I'm also hostile to that provision, and I need to communicate it now, that anything to do with amnesty, I will propose to the committee a total removal from our statutes so that people meet their obligations as and when they are due. So it's my position, Honorable Chair, with the matter of these due process provisions, which are sought to be amended. I mean, if you have an obligation to pay taxes, Why should we allow you all that latitude when we need money to also run government together with you, not us, in government? And I'm addressing this issue because this is a joint effort, and taxation indeed is ultimately the role of Parliament through legislation, and not us. Lastly, I would want to hear you on what was initially being proposed in terms of reviewing the income tax band. Okay, we want to relieve the burden to the population earning so low, while also being able, to run government. How do you want to, assist the government to do that when you continue to make these proposals of zero rate, do what, and all these other issues? When you have an obligation to pay taxes, pay, that we can also run government. I thank you, Honorable Chair.
I was very tempted to cut you short, to stop you. But maybe it is important that I clarify that the views raised by the Honorable Member are his personal views. And,
yes, and they're personal.
They are not views of the committee.
Yes.
You don't have the floor, Honorable Kaduma.
Yeah, thank you.
So the decision will be made by the committee, and we shall be very fair, and we will give all the submission a fair hearing. And I think I really need to clarify that.
But Chair,
because otherwise there is no need of
Chair, without reprimanding you.
And I'm not part of those views.
Order, honorable members. Otherwise, order. You are the first out of order. So.
Because Chair, I've said that when the committee says, I'll address those views, and I want them to persuade me. You think otherwise?
That's okay. My question is to members, Order, Honorable Mboni, you need to be careful in your choice of words. Otherwise, then it could be taken that public participation is an exercise in futility. If you already made a decision, these are proposals from the National Treasury to this committee. We shall give them a fair hearing, and we shall make the best decision for the Republic of Kenya. And I think we want to give that assurance. And for the last... for the last 3 years, you've seen the bill that comes from National Treasury, and what is passed at the House has changes, most of them from public participation. Public participation is not an exercise in futility. Your views will count, and it will matter, and see them in our report.
Chair, you've already made a ruling, and I think that one stands, although from the perception of Mheshimiwa, it is not a portion of the committee. Committee will be informed by, as Chair said, by the contribution of the stakeholders. But I think Mheshimiwa is bringing out an issue that is of a mature level that also we need to look at as Kenyans, especially as the economy is behaving. That yes, we need to lessen the cost of doing business through this proposal on VAT, but at the same time also we need to consider disposable income for our lower income earners. But at the same time also, we need to ensure that the government has ability to deliver on its mandate, so that these things are compensating element. So we must be able to look at all around it. And then it is time that for those things that have remained constantly on that schedule, zero rated for long, it is high time also we evaluate how is it impacting on our growth. Because we need to look at the growth, we also need to look at the interest of the consumer. Because this is known by the few people who play. The entire population of consumers are not even aware. Other drivers of the cost, we've seen they are going up. So I think this time also we need to have a mature engagement even as we move forward, so that we don't stick to one point and kill government ability to deliver, and also kill in the long run government creating enabling environment for traversing of business. Thank you.
Thank you, CPA Ruto. Mine will be seeking a point of clarification on several matters. On the tax, on the school fees benefit to schools. I remember last year we had a spirited discussion with KAM, and they were very supportive of the amendment we did last year, increasing the tax, the benefit of food. When you give food to employees, then I think we increase that threshold. I forget by how much, so that it becomes a non-taxable benefit to a particular extent. And that is food. So then, how do you explain why you would want to? So the same way there is a that food is a tax that food is a tax allowable benefit to a particular threshold. Okay, if your employer, if you use your employer's car, that is a taxable benefit, even when you're using that car to transport yourself to work. Then you might want to justify more why would want this, how that then is not a taxable benefit compared to all the other benefits to staff that becomes taxable. The issue of zero rate and exempt, has had a lot of back and forth. Sometimes we've yielded, this committee has yielded to stakeholders and taken them back to and retain them at zero rate. But Treasury keeps coming back to us that the benefit of the price of those final products does not reflect on the shelf price of those particular products. And they're accusing you of, you get the benefit, but you do not transfer that benefit in terms of price to the consumer. However, whenever there is the opposite, then you're very quick to increase the price of that particular product. Of course, there are many factors constant on coming up with that price. But I think you may want to justify more how the guarantee that you'll give that actually that transfer has been proven to benefit the customer and not to increase the profitability of your business. And maybe lastly, what I might persuade to you for sectors that are very sensitive, and like what Dr. Wirimo was saying on the pharmaceutical sectors, what we've done in the last Finance Act and the other one, in some of these sectors, is to make it exempt. So we make the end product exempt, and we also exempt now the raw materials, so that the net effect is that we make it exempt raw materials and then exempt final product. So maybe for those particular materials that you think are very sensitive, and therefore instead of now being zero rate, maybe you can tell us who they are, so that now we exempt the raw materials and we consequently exempt the final products. Because really our intention is not to make medicine, for example, or whichever other critical services or goods much more expensive to our population. I think the other things you explained on bad debts increase from 2 to 3 years, on tax on cards, on carry forward on tax losses from 2 to 3 years. So I think attempt to respond to those questions asked. And on pay bands, we had a long conversation with the KBA last week about the tax bands. And now the feedback we are getting from National Treasury, and maybe you may help us also inform us maybe better. And a parallel program is ongoing on the other side of town at along Mombasa Road with the Budgets and Appropriations Committee about the budget. So we have a budget of this financial year of 26-27 around 4.75 trillion shillings. So that pay band, the pronouncement by the minister that they will reduce the tax, the minimum taxable income from 24,000 to 30,000. When they did their simulation, it's giving a dip of that 5 billion shillings on the expenditure. So now they're saying that then we could yield this, but then we'll have to cut Kenya shillings, that 5 billion shillings from the expenditure side, which is a very uphill task to do. Of course, there's also the argument that if you increase the taxable, the disposable income, then there could be improvement on other vote heads, such as excise and VAT. But now, collating that and finding out the actual numbers for that is what now is difficult. But maybe you could employ your thoughts on that. Again, it is not an exam; it is a debate. We are giving you that is the beauty of our constitution. You are given a chance to debate those matters before they go to Parliament, so that your views are actually relevant. Proceed.
Thank you, Chairman. And we fully sympathize with...
So, Chair, before you conclude, before you respond, FCPO, you like to introduce yourself? And you know, usually the hit is usually on this side, on the revenue side. The discussion on budget is that we want budget for education increased, we want budget for health increased, we want budget for roads is increased. But then nobody wants to take a cut on the budget. But of course, the other side, because it pains us, that's where the problem comes. Yes?
Thank you, Chairman. Chairman, I'm sorry I came a bit late. My name's Joseph Oyula, Member of Parliament for Butula, and a member of this Finance and National Planning Committee. Chair, I just want to assure our visitors here that this committee is always very fair. We look at every corner before we come up with the decision. So the Treasury brings forward these items, and we are here to get the views from you people so that we can present to Parliament what is almost balanced. So do not fear anything. We will be very fair, and you have always known that. Thank you.
Thank you, FCPOla or Chair.
Thank you very much, Chair. And I totally agree and sympathize with the position that the government is in right now, with 68% debt serviceability. For every 100 shillings you collect, you are paying away 68. And that is not an easy task by any business to do in this room or elsewhere. And it's difficult, and what you've done in trying to stabilize the ship with the macroeconomic indicators, I think you've done a fantastic job. But at the same time, we must not forget the reality on the ground, and we cannot just disconnect ourselves that we've done a good job in a macro picture, that the micro picture is fine. There is still pain for Wanjiku, and that's really what we're trying to address here, that how can we move this away? How can we look at the budget? And I know there's a whole team on the other side looking at budget, because on one side, when you've got a balance sheet, you've got to look at your expenses and your income and your expenses. And if you keep only looking at income and not cutting expenses, of course, you need a lot more income. For example, you said 450 billion for counties, which is true, but where are you going to get it from? And I would like to give you an example, sir, of just one sector where the zero rating of exemption of VAT becomes a COGS, means cost of goods sold in your balance sheet, in your business. And Chair, you also mentioned that we don't see a reflection of those exemptions or those zero-rated VAT in the price of the final product. And why is that the case? I'll give you an example of one sector, the floriculture sector, and I'll give you 3 companies in that floriculture sector. And I don't mind naming them because they're my members. One company is Flamingo Flowers. They're in Naivasha. They have got $14 million outstanding VAT. And all they do is 100% export. They don't sell anything here. This is just inputs into their floriculture business, which is cartons and polybags and pesticides and things like that. 2 is Del Monte. They also owed a lot of money. And 3 is the tea plantations in Kericho called Browns, which was Finlay before. These guys combined, 3 of them, have got $45 million outstanding. And I've spoken to each and every one of them. All of them have committed, they are willing to put back 50% into new investment, new jobs, new production, new profit for Kenya, more taxation for Kenya. So you can see when you're stuck in a quagmire, what do you do?
Mr. Chairman, when I think Flamingo appeared before us, they said they are willing to invest 100%,
Correct.
not 50.
No, I'm saying combined. Because some were not going to do 50, but between the 3 of them, 50% they're willing to invest. So what I'm trying to say is there are certain things that we can do as a committee. For example, if you're already exporting 100% of your business, and we already know where cash flow problems that my friend mentioned because of high debt serviceability, why don't we allow these companies which are already doing 100% export to migrate from current ecosystem and just go into special economic zone? So once you create a reclassification, there's no refund to pay, no VAT to pay. So I like what you said, exempt, win-win situation. So there are situations we can do to help them. And if we do that, it's very simple. Then we don't talk about VAT refund because you're talking the same language that we are talking. If it's exempt, it is workable. But if it's zero-rated versus exempt, it's not workable. And sometimes the translation doesn't really happen because the zero-rated, which allows VAT refund and the refund doesn't come, which is not forthcoming, becomes COGS for me, cost of goods sold. So I think those are the things that we must talk about. And it's good to be honest and candid that we are addressing the cost of doing business in Kenya. Because if Kenya is uncompetitive, we have a bigger problem. We cannot afford to be uncompetitive. We have 40% of East African community today. We need to grow the jobs. We've got 1 million kids coming out of school, and we have a moral and social obligation to give those kids jobs. And what we saw 2 years ago in 2024 with the Gen Z uprising was purely a jobs agenda, and everything else became political around it. But the truth of the matter is our kids are looking for jobs, and the only people who are going to deliver jobs to those kids are people in this room, the private sector. I just want to pause there, give it to Jilna, and for schools, I'll give it to her, and also for the pharmaceutical. Thank you.
I think there was a question raised on the VAT refunds on the move between the 2 years, sorry, from 3 years to 2 years and what we have seen. And at the moment, the fact that we can now apply for a refund sooner has not really transpired into getting the refund out sooner, obviously. There's a challenge there. So we are facing a practical challenge where we are not able to get the refund on time from the Revenue Authority, but at least the application can be made and the process can be started sooner. Because the administrative process of even getting a refund out of KRA takes a bit of time. In terms of numbers, I would not be the one to have that number, and I don't think even the Revenue Authority has ever published such a number before for us to actually verify whether this has actually worked or has not worked, or it has saved how much, because the problem is still the cash flow challenges that the Revenue Authority also says they have from the National Treasury. But that should not be used to penalize the business, because it's my duty to lodge the application for the refund in time, and then we know that there's a process that goes around refund audits and all that before the approval comes, and then the disbursement process. So the challenge is the disbursement side of it, not the other parts. On the part of amnesty, remember the amnesty, the question was not to give. And we understand, yeah, this is almost the 4th amnesty that we are looking at in this regime. The challenge is, there's also been on the other side, and I think the previous presenters have already said it, that these are not deliberate mistakes, let me tell you. These are serious, just genuine mistakes that happen by taxpayers, because the amount of changes that we have had in the past few years, something being VATable, not VATable, moving from here to here, so there are genuine mistakes that have happened by taxpayers. And because compliance has become so bureaucratic, I would use that word, because even though we have simplified it with the whole digitalization, the amount of changes that have happened, these mistakes are likely to also happen by taxpayers. And it's not out of gross or willful neglect, as we call it. It's actually genuine mistakes. Hence, these amnesties go a long way for people to clean up their affairs, and they would genuinely also like to do that. The only thing we are requesting is that if you can give us that additional window up to June, because again, cash is not moving in the economy. There was a mentioned that now debtor days have moved from, and I'm sure the manufacturers will also confirm that, it's moved from what, 60 days to now 180 days, and in fact even longer. The monies are not coming, and from government it's not even coming, far more, where you're supplying to the government. Hence the challenge of getting cash out to actually now go and pay for these amnesties, or even pay genuine principal taxes, which people are struggling to collect and pay. And that's a real challenge that we've also seen. On the issue for the VAT Act, and I think going back to your question of zero rating and all that, I think we also need to pause and go back to history times when the VAT Act was first introduced. And let's go back and understand that VAT Act was changed. And at the time of change, a lot of thought actually went into it to establish what is actually exempt, what is zero rated. But subsequently, over the last 13 years, we've seen a complete overhaul of that act. So that is also part of our own doing, and for all of us in this room, actually. But there was a lot of thought and reasoning that actually went behind why that act was originally, and there was a lot of sensible thinking that went around it. But now we have also gone and changed the entire act from God knows how many provisions to how many provisions we have, say, for example, in the first schedule. So I think it's also time to re-look at what was the initial intention of that act of 2013 and why it was changed and where we are now, and go back and see if that's something we could look at considering. But I think on the issue for POI bans, I know the CEO of KBA wanted to just contribute. So Raymond, would you like to just make a comment? I think there's a mic there.
Thank you, Chair. And to the question asked by Honorable Peter Kaluma on pay-as-you-earn request by the private sector for the 5% reduction across all bands. Here we are coming to you as partners and solving that question as to how do we generate more taxes for this country. The proposal for the pay-as-you-earn free up to 30,000, and then the 5% reduction on pay-as-you-earn up to 50,000, that creates a hole in our revenue. That one creates a hole, and I agree with the National Treasury fully. However, on the flip side, what you're saying, 5% across all the tax brackets, that creates an opportunity. Because in this economy, on the MSMEs that we're talking about, on the agribusiness that we're talking about, on the value chains that you're talking about, it's driven by salaried workers and individuals. And remember, the pay-as-you-earn brackets, they don't just apply to salaried workers. They applied to all individual income earners in Kenya, even if you are a consultant. When you pay the 5% withholding tax, the final tax you're supposed to pay are based on the pay-as-you-earn brackets. So if the 5% was withheld, you'll be told, where's the 25% when you're doing your returns? So pay-as-you-earn bands applies to both salaried workers and individual Kenyans in businesses. As private sector, and more specifically as Kenya Bankers Association, we've been on this subject for the last 3 years. And the data that we have been able to look at, and that's why we're asking for the 5%, is the fact that if you come closer, just to banks only, 5% across all banks will release 28 billion. Data that we have from the banks show that any increase in salaries to staff, 50% of the staff actually go for loan facilities with that increase. So if you only take 14 billion of the 28, that will enable workers and even, as I'm saying, individuals to be able to access loans worth 140 billion Kenya shillings. That's what you're saying. Applying on loans only, even before you get into the consumption, it expands the economy to the level of 210 billion. And that one, if you compute on our tax to GDP ratio of averagely 15, you find that we are able to get 33 billion shillings from this expanded economy of 210 billion. So this proposal is fixing that question as to how do we make the economy vibrant? How do we create new jobs? And again, the data we have shows that 36,000 new jobs will be created every year, courtesy of this measure. So here what you're saying is we are spurring local investment, and then on the other side, when you ask retailers, the way Ombui indicated, we are also creating a market for the trading business. So here we come as partners to really solve a problem and not create a hole the way it had been proposed initially on only the lower income earners. So that will be my response.
Thank you, Chair. I have been asked to support now that Raymond has called me out. In a most simplified way of saying that, if I have more income in my pockets, I can spend more. If I spend more, I spur manufacturing. If I spur manufacturing, we spur employment. If we spur employment, the two between employment and manufacturing, we increase the income to government. So we're looking to give more people money in their pockets so that they spend, so that manufacturing works, they're able to create more employment, and government has more sources of income.
All right, and to answer the education benefit we are requesting, Let me paint a picture to start with. There is a misconception in this country about what private schools, private colleges look like. Majority of the private schools, there is an assumption they look like the high-end schools. But majority of private schools in this country are low-cost schools. And in Nairobi alone, 80% of children receive their education from a private school. Now, with that background, we absorb a lot of, we absorb people into employment. If you give this to us, we are not able, these schools that I've just spoken of, they don't employ at humongous salaries. They employ at modest salaries at what they can afford. So what we are asking for is to allow us to help government. We are a low-hanging fruit as a sector. Allow us to help you, help us as a country, and we all benefit. If we are able to offer this to employees, for them to bring in their children, and they don't pay school fees, or we give them a concession, we can employ more teachers. We can employ more staff, which is more payee to you. If you think of school as an ecosystem, it is not just the teacher or the manager, it is the cleaner who cleans the school, it is the watchman who is at the gate. These are people who would ordinarily not afford education at that school. We are asking you to allow us to help you provide that access so that they do not pay school fees, and we can employ more of them. In terms of whether it is a taxable benefit, I'd ask you to look at it like that. And there is comparable practice in this country. Lecturers in public universities either get this as a concession or free, and that allows their salaries to stay at a certain level, which saves government money. For example, what a lecturer is paid at a public university may be significantly less than what they're paid at a private university. But because they're able to get this concession, and it is not considered a taxable benefit, then government can keep their costs low. So I think as a sector, we provide an opportunity to both partner with government in expanding access to education, in actually expanding equity, and in providing more in terms of payee, because if we get this, we can employ more instead of combining functions. Thank you.
I think for the farmer.
Yes. Thank you.
You make a compelling case, but on a light note, that's the risk is other sectors doing the same. So where a nurse now who works at MP Shah says now, because now I want to deliver here for free, or but anyway, you make a compelling case.
Thank you so much, Chair. And I think I would want to focus on the question that came about on the impact of the zero rating status in terms of cost. I think our submissions, if you look at our second page, has been very transparent as to how much we expect as a percentage saving from just zero rating of pharmaceuticals. And just to give a scenario, if today the numbers are right, that 91.5B is what is being claimed from SHA, and considering the WHO ratios say that 60 to 80% of that is medication, that means 57 to 72B is medication. A government saving of even 10% of 5B means that money can be rolled over to other primary healthcare activities that ensure that there's a saving from that point. Exempt status is still a challenge because, again, the input VAT aspects are still existing, and the manufacturers are not able to make that claim. Another justification, and just to let the country and maybe the committee know, is that from an African perspective and also from a local manufacturing perspective in Africa, our president, His Excellency, is actually the manufacturing champion for Africa in the region, which means that local manufacturing in terms of health security takes center stage from that aspect. So when it comes to the manufacturing environment, it is not optional that our country should have one of the best environments for incentivization of investments externally, as well as internal facilitation of making sure that our health security when it comes to medicine is actually protected. I think that is what we were asked to do, but even just from a global perspective, a lot of the countries at worst case scenario, they have a staggered approach towards the zero rating. And for Kenya, for our Kenya essential medicines list, we are recommending the zero rating, but at worst case scenario, a 1 to 3% consideration of VAT aspects, so that the input aspects are actually taken, are actually considered from that zero rating. Thank you so much.
Thank you. There's just one clarifying submission, and then we close.
Just to state that we are not looking, we understand, again, that you have fiscal considerations. It's a difficult economy to manage. But we are asking, even if it can be, can it not be the full commercial value, not full commercial fee, so that we just tax at the cost of education. We are saying, can we talk so that we can employ more?
So thank you very much, the Kenya Private Sector Alliance, for your very, very good contribution and for continuously giving this committee very good ideas and a realistic view of what these proposals would mean to the sector. We shall endeavor the best to support you and try to accommodate as much as we can in our report, and hopefully convince the plenary to agree with us. So thank you very much. It being 1:12 p.m., I want to ask KM for indulgence that we break for 1 hour lunch break. We'll come back here at 2 p.m. I am told we have to refer to procurement about invitation for lunch. Now, let's start with the KM because we're supposed to be in morning session. Let's try to see how many are able to accommodate for lunch. Thank you. See you at 2 p.m. Have a good, enjoy your lunch. So please allow me to extend an invitation for lunch to all of us. So hopefully we will fit there, all of us.